suggestions for putting together a cash flow forecast or revising one if you have one already. We're going to be sharing some ideas and resources. It's not interactive, but we will be hopefully doing an interactive webinar version in the near future where you'll be able to ask questions and share ideas a little bit more easily. I appreciate that there will be people tuning into this who have various levels of knowledge and experience of finance, so we will be covering some basic concepts, but if I go too fast, you can scroll back and watch things again, but I'm aware that you're probably not operating with your usual finance team at the moment, or your trustee team. Maybe your treasurer is not available because we're all coping with the sort of emerging situation. Do keep in touch after today for ongoing support and advice from us. Just a couple of slides up front. If you've looked on our website, we've got a blog on there at the moment, which we put up a couple of days ago. One of our volunteers from the professional community, she's an insolvency practitioner. She's written a really nice little blog about cash flow and why it's so important at this point. So cash flow is the name given to the process of money coming in and out of your organisation. So we're talking about cash here, not other concepts. We're talking about actual hard cash going in and out of your bank account, and the importance of having more cash coming in than going out so that you can meet your obligations as they fall due. The saying is cash is king. I don't know if you've heard that one before. The full saying is actually revenue is vanity, profit is sanity, but cash is king. So without cash, you are not going to survive. Your business isn't going to survive if you can't meet those essential obligations as they fall due. It doesn't matter how much on paper you're making in terms of profit. If you don't have the cash at the right time, you won't be able to pay your salaries, your tax, and those are typically the ones that will cause you to go under if you don't meet those when they fall due. The coronavirus crisis and what that's brought to the fore is that there is a definite cash flow problem for most charities at the moment. One is their income or funds and donations will be reduced because donors are worried about their own finances, and got lots of calls on their own finances, and also fundraising events have had to be cancelled or won't be going ahead. And on the other hand, some of your demands on your services will have increased. There'll be more people to help, more individuals requiring. So charities need to revise their existing cash flow forecast or create one based on the changed circumstances. Take a look at their reserves, see how they can be accessed, and to what extent you need to maintain some additional reserves for an even rainier day, if we can imagine one. You're also looking to find other offers of pro bono support, other sources of funds and grants that are available, and we've got a few in our links and resources below. You're also looking to reduce costs, obviously, to stop unnecessary expenditure draining out of the organisation, postponing any projects that you can postpone, prioritising services or donations or grant giving if you're a grant giving organisation. And that means some difficult decisions you may have to make to survive at this point, and that's a matter for the board and management to look at. But a very important part of that is having good financial forecast information to make those decisions on. So good, accurate, up-to-date information will help you make the right decisions. You also need to be looking at the latest information from government about loans and support that's available. The guidance changes incredibly quickly. I've got, as I say, some links at the end of this presentation, which are, will go out of date in a couple of days. You may be looking to join forces with another charity or with a peer group of charities, a local charity hub or organisation that may have similar aims or be in a similar sector. This can certainly help reduce your costs and control your cash flow until the crisis comes to an end and you can revert to your normal operations. But most importantly, the advice is to seek advice, to talk to other charities, talk to debt advisors, talk to insolvency practitioners if you need to, and look at ways that you can make sure that your forecast expenditure doesn't exceed your income and that you can continue. So lots of opportunities whenever you get the opportunity to talk to, whether it's your landlord, your grant givers, your donors, funders, etc. Anybody that you're working with, any parties to any contracts that you're operating to at the moment, to defer and discount and rearrange deadlines and so on, and maybe looking at some of the restrictions on funds, lifting restrictions on funds, or relaxing targets or performance KPIs and so on, just to help you survive in the next challenging few months. So that's what we're all doing at the moment, and revising your cash flow is just one of those things that you're doing at the moment in the scrabbling phase, just to recover or pull together during this disaster phase, to emergency fundraise, whilst communicating with all your stakeholders, doing all those negotiations. One of the things that I have seen is the HMRC allowing deferral of VAT payments. I've also seen the Companies House allowing extensions, and I think it's 2 months, but I have seen 3 months banded around somewhere. Extensions to the accounts filing deadline, but you have to apply for it. So in the normal way that you file, you should apply for the extension. It's not automatic. And there's lots of people out there starting campaigns to get more support for charities. So if you want to follow those, the hashtags, a couple of examples I've seen today: Everyday Counts and hashtag Save Our Sector. You'll then move into the sustainability phase, where you've done your original scrabbling, you've put a few things in front of your board or management, and then you start looking at some of what things you can implement, maybe redeploying resources and staff, working with peer groups to share knowledge, moving to digital or remote platforms, possibly recruiting more trustees and volunteers, just getting more workforce on board. And then you'll be moving to those next steps, which will be sort of trying to be a step ahead of this in the future if it does happen again, building some resilience into operations and moving to remote working in some cases, which people will have adapted to during this crisis. So as an element or an aspect really of that whole approach, what is cash flow forecasting and why do we do it and how? Why is it particularly important for charities? Well, we've looked at some of the challenges for charities, and definitely the funding environment's very complex with your restricted funds designated, all your different projects and different pots of money to be spent in different ways and under the management of different people. It makes it a lot more difficult to run your organisation, run your business. Income is lumpy, uncertain, erratic, and we'll see that when we put our cash flow forecast together, not predictable. You also have that strain that you have to maintain levels of reserves for future operations. So, you perhaps don't have access to finance and loan and overdraft facilities that organisations, other sort of commercial organisations have. There are significant changes in the sector right now, which make it difficult. You've got that obligation to show good stewardship of your funds to all your stakeholders and all your people that you report to, and so on. And you're also in that position where you need to spot opportunities to grow, to meet the demand. You still have that mission to go out there and do what you're set up to do, and that requires you to look for opportunities when you might have that money. So knowing what money you're going to have when is really, really important. As with any organisation, if you run out of cash and you can't meet your obligations, you're trading insolvent, and that actually is an offence. It's a criminal offence. So trustees and directors need to be absolutely sure. If you're a KIC, you'll have directors. If you're a charity, you'll have trustees, and those individuals need to know the risk of trading insolvent. And one of the things that can mitigate that risk is to have a good cash flow forecast that it spells out exactly what money you've got due and when. So what we're looking at now is what's the difference between the budget and the cash flow. So the budget is it's for a defined period of time. It's the amount of money you expect in total you will expect to earn and pay in expenditure over a certain period of time. So you might find that will leave you with a certain surplus or deficit at the end of the year, but it's an all round this is what we're going to earn and this is what we're going to expend in that period. Whereas a cash flow is focused very much on the cash inflows and outflows in that period and actually when those will occur. So we're more likely to break that out by month and absolutely try and nail down when that actual cash comes in and out. Some of the items we describe as non-cash transactions, such as depreciation, might feature in a budget but not in a cash flow because it's not a cash flow. Just going to skip another slide to explain that. Depreciation is a kind of an accounting trick that we use to spread the cost of something in our accounts, in our financial statements, that we've bought, for example, an asset that we've bought and expect to use over 3 years. And in the example, I've used a photocopier. We would spread the cost of that asset over the 3 years on a flat, on a sort of a flat rate basis, to just kind of allocate the cost to each month in an accounting way, but it's not. There's no cash flow between one statement and another. That £10 doesn't actually move between the P&L and the balance sheet at all. It's just an accounting trick that we use. So you wouldn't put depreciation in your cash flow because there is no cash movement at that point. You've already bought the asset. That's where the cash has been expended, and you don't have to move cash after that. Similarly, accruals and prepayments aren't going to be reflected in your cash flow, because accruals is where you've earmarked money to expend on something in the future. So you haven't spent the money yet, so it doesn't go through your cash flow. And prepayments is a kind of way of taking into account money you've paid in advance for future periods, and you've already paid that money, so it doesn't need to go through your cash flow. So that explains cash and non-cash transactions. So consistency is important. Use the same captions and headlines and headings that you use in your income and expenditure statement, in your cash flow, so that everybody understands where you've got them from. Try to make them look just like the statements your readers of the accounts are normally used to, so your trustees or your management. Try and keep them consistent. It's always a good idea. Don't forget your on-cost to salary. You might pay salary in the month, but the on-costs are normally paid or in the following month. Your payroll taxes, your NI contributions. So stick rigidly to exactly when things are paid in your cash flow forecast. Reflect the months in the cost you will pay them, in other words. Reflect receipts of money when you expect to receive them. So be realistic. If an organisation says they're going to pay you a grant in May and September, but you know that they always pay it in June and October, then you put it in June and October in your cash flow forecast, because you've got to be realistic. You've got to try and reflect what will really happen. I do say don't leave anything out, however small. For example, you might traditionally have had a very low budget for mobile phones and IT equipment, but suddenly now that has become more significant. So, keep that in there, and then it's there when you need to use it, when it does become more significant. So try to keep it as comprehensive as possible, your cash flow forecast. Include VAT if you are registered and you can claim VAT back. Include that as a future cash inflow. The important thing here is to have enough precision for the decision. So we're not talking about getting it down to the nearest penny, but enough information and enough accuracy for you to make good informed decisions based on this cash flow. So we're going to use what we call a rolling cash forecast. So you could use a 1-year forecast, but we tend to recommend you go out maybe 2 or 3 years. In the example we're going to do in a minute, it's just 1 year because it couldn't fit much more on the screen, to be honest. But in reality, if you flex this out to 2 or 3 years by month, it just gives you, you're not going to get it very accurate in the sort of 3rd year. It's going to be very much a best estimate, but you're at least looking ahead. And by rolling cash forecast, we mean when you finish 1 month, you add another month to the end. So you've always got 36 months or 24 months if you're using 2 years. That rolling nature of the cash forecast, you don't come to the end of it then and suddenly fall off a cliff. You've always got that, 2 or 3 years ahead rolling forecast. Your cash inflows, we've just spoken about the ones that you have in your accounts at the moment, your grants, your funders, your income, your donors, your sales, your contracts for services, your memberships and subscriptions, or whatever those categories are. They all need to be in there, itemised. And then your cash outflows by category. So some of those cash outflows are very irregular. Things like salaries, rent, they're very fixed and they're irregular. They're prorated during the year or maybe quarterly. So they're quite easy to do. Other cash outflows, you might have to sort of rely on, look at your budget and see what's been approved, when that's likely to happen. You might have to fit those in particular months. as I say, so it's always a good idea if one person prepares the first cash flow forecast and then somebody else reviews it, because two heads are always better than one. It's very good for that second person to sort of challenge, what's this number here, or why have you put that in this month, or have you forgotten this, or we should be putting that here, and just get a little bit of a challenge there. Start with your opening cash balance that is your actual opening cash balance. So you're starting with something which is, evidenced by, your bank statement. So it's got a link with reality. So then you have your opening cash balance, your inflows, your outflows, and you have a closing cash balance. And that's what we're going to be looking at, the closing cash balance over time. What does that look like? Is it going up and down? Does it ever get really close to to zero? And what do we need to do about those months where it does? If you need to at this point, and it's always a good idea anyways, to have two scenarios. Maybe you've just put in for some funding and you don't know whether you're going to get it or not, or you've got a couple of tenders out there. You may need to do two scenarios. One if, this happens, and another plan B, if you like, if something else happens. And that's not unusual. You can keep them on the same Excel book, just different pages in the same Excel book. So create the forecast using the headings you normally use, open it with the current cash balance, put in all your expected cash inflows, and that's what actually will go out of your bank account. And your cash inflows and your outflows, what will go in, what will actually go out, being careful to be precise about those. And then your closing figure is your predicted cash balance and becomes the opening balance in the subsequent month. Use comments and narrative wherever you can to explain why you've done things, so what we call assumptions or explanations. That's really important, because 2 or 3 weeks from now even you might say, well, why do we use that? Why do we use that number? Why didn't we use the number that we'd all agreed at the meeting? Or you may need to just have some explanations just to explain why you've used certain numbers. Remember to exclude things that are not cash flows, i.e. things like depreciation. And then roll it forward with your actual cash balance at the end of every month. So you're always starting every new rolling forecast with an actual number. So here's the template we're going to be using. I've got this template from a site called thesmallcharityfinance.org. And the link is at the bottom there if you'd like to pick it up from there. Equally, you could set up your own template quite easily on Excel. So you've got the months across the top there. We've gone with January to December. Each of the months, you can see we've got income and expenditure in those cells. We've broken out the income between grants, fees and charges and in events, and you can see immediately fees and charges is prorated on a flat line basis across the year, but the events and grants are lumpy and coming in at different times. Similarly, the expenses, some of them are prorated across the year quite evenly, others are in lumps. But what you've got on line 20, you've got the cash balance at the start of the month. Then on line 19, you've got the net in or outflow from the cash flows in the month. And then on line 21, you've got the cash balance at the end of the month. And that's the key number that we're looking at there. The cash at the end of every month is the key number that we're trying to get to. And we're mapping that because we want to make sure that we don't go overdrawn, because in this, I'm going to assume in this case we haven't got an overdraft facility. So already you can see in months January, February and August that we're in the red. We've gone overdrawn. So we've got to have a look at, how can we manage that cash flow? What can we do to take us out of that situation? If you look on column O, you've got the sort of total income and expenditure for the year. So you can see that income exceeds expenditure. You've got 328,000 of income, you've got 319 of expenditure. So you've clearly got a surplus, but it's the timing of when those amounts are coming in and out that's the problem. So what I'd like to show you now is a little graph that can sort of visually, quite easily and quite impactfully demonstrate this income, outgoings, and it's using a chart in Excel called Combo. So if you go to the Insert menu and select Combo, you use the total incomings, total outgoings, and your cash balance, the highlighted balances there from your cash flow forecast, you can create this chart, which is quite useful because it does show you those incomings, outgoings, shows you how lumpy they are, and shows you exactly where the bank balance ends up at the end of every month. It's a really useful one if you're using the forecast to really quickly update your management or your board about the cash flow forecast. This is just a slide to show you how to make that chart. Those are the balances to highlight to then create the chart in it. And that's the final, and that's the actual final chart, so that you can see January, February, and August are the bank balance is below zero. So in the second scenario, I don't know if you remember in the first cash flow, we'd highlighted a couple of amounts. Publicity and fundraising. I think in January we had 10,000 of expenditure in publicity and fundraising we expected to pay. And then in July, I think we had 5,000. So we had 15,000 in total. What we've decided to do, we decided that that was a cost that we could change, we could adapt, or we could defer, if you like, so as to not go into the red, so as to not go overdrawn. So what we've done is had a word with the supplier of that publicity and fundraising service and said, yes, we do need that those services, we do need them in advance of our event in April, but can we change our terms and conditions with you a little bit so that the work takes place a little bit later, and you allow us to pay in 2 installments. So it just eases that cash flow. It takes away the risk of going overdrawn. Hopefully, if you've got a good relationship with the supplier and you're not, you're keeping them, they're keeping you as a client, you're keeping them as a supplier, but you're just modifying those terms and engagements. If they're amenable to that, you would be able to defer the expenditure into those, the actual cash outflow into those later months. And equally, back in July, instead of paying a lump sum of money, you're able to split it into 3 installments. So it's just an example of how you can have a second scenario, if you like, where under the first scenario you've got a problem, you've got negative cash flow, and you're in the red. In the second scenario, you've actually resolved that by just deferring one of your payments. And when we do a combo chart on the basis of that second scenario, you can easily see that yes, the expenditure is leveled out a little bit, it's evened out a little bit, and you haven't gone into an overdraft position, or you're not overdrawn in January, February, and August. So it's a simple example. As I say, take the template and use that if it's helpful to you. Use the combo chart if it's helpful to you to demonstrate, very easily and visually what's going on in the forecast. And you can dig deeper as needed. If you have to have any conversations with suppliers and so on, you've got something to work off and to create a second scenario. So now you've got your rolling cash forecast. How do you use it? My suggestion is that you focus on the 12 months, the immediate going concern sort of period. If you have an audit or an independent examination that may mention to you what the going concern concept is, it's, are you going to be afloat for the next 12 months? And that's how you would normally use a rolling cash flow forecast. But in times of financial distress, you might be looking at the next 3 months or 6 months, or even the next 1 month, as we've seen in this example. Focus on the immediate issue. It's an essential report for your CEO and for your board and for your finance committee. It is very important. It shows where you might have a pinch, where you have a shortfall, and it helps you make decisions that mitigate that risk to the organisation. It's a forecast for you. It's for internal purposes, an internal document. You do not need to put this in your financial statements. You don't need to put it on your website. You will only give it to people if they're authorised and asked for it. So, for example, a funder may ask for it, or a bank, or somebody who's loaned you money. But essentially, it is an internal tool for your own internal management. I would say be prudent and don't count anything into income unless you've got some real support for receiving it, or a justifiable sort of forecast. We tend to book in expenditure as soon as we're aware of it, because we're being cautious, but I think you've also got to be cautious about income, because unless it's nailed on, as they say, it's very difficult and very dangerous to sort of assume you're going to get income. It's very difficult to predict income, though. I do appreciate that. It's very difficult, especially if you're a new organisation. But it's difficult at most times, and at this time, it's going to be a very challenging time to raise income. So you do have to use your best estimate, or ask around what other charities are doing, and don't be afraid to ask your contacts and network and talk to us. But at the end of the day, it's better to know bad news sooner rather than later, because the sooner you know you've got to do something, the more time you've got to plan your way out of trouble, and you have time to work on a solution. So how often should you revise this? On a normal situation, monthly would be enough. But if you're in financial trouble and you are facing unusual stress financially, then it could be as often as weekly or daily that you need to look at these numbers and keep them up to date. All the forecast information is future information, so best estimates are apply. But always start with your true cash balance. Make sure you got that right. You start with the proper cash balance. These days, that's often the same cash balance that you have in your books, if you like, because of online banking. Everything's reconciled at the end of the day. Payments are pretty much instantaneous. There used to be a time when if you were writing a lot of checks or receiving a lot of checks, that you would, for example, put a check in the bank, but it wouldn't clear for 3 days, or you would write a check and you would record that in your books, but it wouldn't be clear. It wouldn't leave your bank account until a few days later. So there was always a little bit of a gap or a reconciliation there, which happens less and less. So, but the important thing is that you use your actual bank balance, and you may be doing a cash flow on a couple of different bank balances, but always use the true. Forecast out as far as you can go. Obviously, it gets a little bit less accurate as you go out ahead. Consider building in the rise in the cost of living, or if you're aware of either grant funding falling off in later years, or costs going up in later years, try and build that in. Add your extra month to the end every time you come to the end of the month. Your initial month's forecast should be very close to what actually happens, because you're usually aware of what's going to happen in the next month. But there are unforeseen events or circumstances that you might be able to put some kind of contingency in for. Generally, have a look at how good you've been in the past at with your actual against budget kind of predictions. If you're pretty good at that and you think you've got a fair idea of what a contingent amount would be to put in your cash flow forecast, then go ahead and put something in there. You'll get better at it over time. If you're a new organisation, you may need to ask around other charities what do they do to what kind of contingencies do they put in, or what kind of variances do they experience. Again, cash is king. It's all about that cash balance at the end of the day. Turnover is vanity, profit is sanity, but cash is king. You will not survive if you can't pay those very important expenses, wages, taxes, important suppliers, etc. It doesn't matter how much profit you're making, theoretically, if you aren't getting that money in at the right time, you will not be able to pay payments when they're due. So top tips for future sustainability: build this long-term financial planning into your annual review of strategy. So because when strategy changes, quite often your activities change and you will need to change your forecasting. Make it part of your monthly management accounts. It's always very good information to have, cash flows as well as cash balances, so people can look ahead and see, well, what's likely to happen, when are you likely to have a pinch. Use the right people, use the right tools, I always say. So the people that are good with Excel, try and have someone review another person's work is also a very good thing to get into the habit of doing. Using the right tools. So if you have an accounting package that has this built in, then fantastic. If not, Excel is good. Excel is always very flexible, very easy to use, and a good way of checking some of the stuff that might be in a package. Document your assumptions, really important. As I say, 3 weeks from now, you won't remember why you used that percentage or that amount or put it in that month. So do document those assumptions. Make sure your planning is realistic with regard to the external factors. So, at the moment, we've got a lot of things happening in the environment, a lot of things changing. Document those external factors and that assistance where it might be available, etc. Keep it simple and agile because things will change. So, keep the tool, don't make it over complex. I have so many people say to me, I've inherited this spreadsheet, I don't understand it, I'm not quite sure what I'm doing. I would always recommend start from scratch with a spreadsheet like this. It doesn't have to be complicated, and it's dangerous if you don't understand what it's doing. So a little bit more on financial stability and sustainability. Everyone's talking about resilience at the moment. It's about, creating those budgets, but operating within them, and also operating within your cash restrictions and what cash you've got, and demonstrating resilience. It's about striking that balance between spending money and making an impact with the charity and what you're doing, and maintaining some reserves for a rainy day. So it's always a difficult balance. It's also important to communicate your charity's position clearly to others so that you look credible, so that people know where you're going, what your objectives are. It's important to have reliable financial information at your fingertips so you make those good decisions. Things won't always turn out the way we expect, so having a couple of different what if scenarios is always valuable. With increased activity, this can bring about unforeseen consequences. You might have to move properties, or you may need to have more vehicles or more staff or more flexible staff, and all sorts of things based on the change in activity, which is going to have financial knock-on effects. And all this is very difficult for small charities and small organisations that don't have access to sources of finances the way a commercial organisation would. So lots of challenges there. This slide, I think, is quite a good demonstration of, where a charity or any organisation should be. You'd be looking to be in that top left quartile or top left piece of the quadrant, with as predictable as possible income flow. So trying to not have those unreliable, lumpy, erratic incomes. So that's where you try to be aiming with all your income flows to get them predictable and also and regular, and also your cost base to be as flexible as possible, which is easier said than done because we've talked about some of the fixed costs that are inherent in a charity, salaries, rent, and so on. They are very difficult to do. It's very difficult to be flexible about those. But as far as possible, if you can make some of your costs flexible, then it just means you're in a more comfortable position as a charity. The other side of that, the absolute opposite of that, is where you've got lots and lots of fixed costs that you've got to meet, and an unreliable income where you don't know whether you're going to have the money in the bank when you need it. I said I had some resources for charities in this fast-moving environment. Some resources from various sources around funding, some funding that's been released by people like Money Savings Expert, some resources that are available from all sorts of foundations and trusts and organisations, including your local community foundation, which actually have access to emergency funding that they've already started giving out in grants. Charities Excellence Framework is a really good one-stop charity website, which has lots of resources around the coronavirus crisis. NCVO has taken down its paywall, so all its know-how stuff is accessible. If you haven't got a disaster recovery plan but you need one, there's an example here, Charities Facilities Management Group, that might be a useful template. And for fundraising, obviously there's forums on Facebook, there's peer support from the fundraising.co.uk, Aberdeen Institute of Fundraising, putting out webinars. And if you have a retail shop, and if that's an issue, running a retail shop at this time, there's an organisation called the Charity Retail Consultancy, which is giving out 1-hour free phone consultation. So just a smattering of some of the resources out there. We also have a site on our website specifically for resources at this point around the coronavirus. What else can trustees do? Well, apart from looking at this immediate, medium-term and long-term actions, which I guess they're all doing already, there is this specific guidance on the NCVO site, governance, what charity trustees need to think about. They need to be wary of trading insolvent, so having that cash flow forecast revised would be very useful right now. I asked some colleagues and friends who are trustees and said, what can trustee do right now to be most helpful to a charity? And the answer from all of them was make yourself available to staff, clients and volunteers. So if you are a trustee, or if you do have trustees, and you do involve them, do talk, do communicate, do pull together. At this time, there's also an increased risk of fraud. You've got your staff possibly dispersed, working at home from different locations, trying to do the same, checking on payrolls before they're paid, etc. But the control environment is challenged and a little bit weaker for everybody being in different places. So be very aware. This is the time when people go on, for whatever reason, I don't know what motivates them, but the fraudsters are out and looking to, send bogus emails to people. Oh, the bank details have changed. Can you please send it to this bank account? And they're hacking into accounts, and there is a definite risk of fraud at this time, with staff working more remotely. So be aware of that. There's also some great resources from people like Business in the Community. Had 3 very good fact sheets, one for businesses, one for communities, and one for employees and staff. So excellent sort of all-round advice like that. So trustees can definitely and should be on top of, as far as we can, of this point. Don't forget your, what you can do for your individual staff and for their health and wellbeing at this point. The NHS website, obviously a great place for any advice on health. Our HRNet advice service, which is an online HR advice service where you can also ask individual questions about HR matters. Please do feel free to sign up to that. It's completely free of charge. That's the link there. There's a great little article, Financial Health and Rights on Money Saving Expert, we just happened to come across the other day. Also, if you've got staff who have family in other parts of the country, there's some great community efforts popping out with things like COVID-19 Mutual Aid UK, which is to help check in on vulnerable and elderly people in different parts of the country. Banks are talking about giving mortgage holidays to individuals. Also, it's a good idea to speak to landlords at this time, because landlords do not want to, and cannot anyway, I think at this point, evict people, but they'll be very happy to keep people in properties rather than, and would be up to negotiating, sort of deferrals of rent and so on at this point. So do think about anything that can be your staff and your organisation safe and sort of sustainable at this point. Finally, some general finance resources. You probably already have favourite sites that you go to, organisations you already subscribe to or belong to, but there's a few more finance ones thrown in there in case you're interested. Things like the Charity Finance Group, Charity Tax Group, and so on. But also don't forget, if you have an auditor or independent examiner, it wouldn't be a bad idea to get in touch with them. They tend to have a portfolio of other charity clients at the same size or maybe in the same position, and can probably share some experience with you right now that they're having with their other clients. So do reach out and talk and look into those. If this was an interactive Q&A, interactive webinar, we'd be doing a Q&A now, but we hope to do this as an interactive webinar.